Hey everybody, it's David. In the last week, we've witnessed the collapse of the second and third largest banks by asset in US history. And today we're going to be reviewing a video where they're talking about the difference between bank rescues in 2008 and today. I'm going to try to relate some things to what's going on in the housing market in general and potentially some Portland and Oregon stats.
Right, let's talk a little more about this with NBC News senior business analyst Stephanie Ruhle. Stephanie, this is the most extensive government intervention in the banking system since the 2008 financial crisis. How do yesterday's actions by the government compare to what was done back in 2008?
You are 100% right. We have not seen a bank collapse and a rescue like this since 2008, but it's very different. 2008 was a contagion for real. It was about an entire industry. It was about the mortgage industry. It was about the banking industry in total being overexposed. This is very unique.
So what she's talking about is in 2008, we had a mortgage market collapse that took down a lot of banks. And in 2010, there was the Dodd-Frank Act that was introduced, which has really made the quality of mortgages and the quality of borrowing in the mortgage industry just a lot better in the last decade. And you could evidence that by the fact that we're at essentially the lowest point in US history for foreclosures.
And Stephanie Gosk mentioned it before. Silicon Valley Bank was sort of different from anyone else. It was the premier bank that funded the startup community, the tech community. In large part, if you were a startup, you had to do business with them. They were the cool kids. It was not cool to be doing your banking with a big bulge bracket bank. Now, unfortunately, this massive concentration wasn't caught by regulators, and it was allowed, right? It shouldn't be that one institution has that kind of exposure to one industry, right? But COVID happens.
Not a direct correlation, but it made me think of something. A lot of times when we have a borrower coming to us to get pre-approved, they think their bank is going to give them the best rate, or who they're banking with, or who their family's banked with for a long time. That's who they need to go to get a mortgage. And that's just not true. If you are a home buyer and you're out shopping for mortgages, regardless of who you're banking with, you should go shop for a second or third opinion.
We know there's huge investment in startups. This bank has ballooning numbers in terms of deposits. They went from $40 billion to almost $200 billion. And what do they do with that money? They made a horrible move and they invested it in long-term treasuries and mortgage-backed securities. Now, don't let your eyes glaze over. Why does this matter? It was a terrible move because this happened when interest rates were really low. So interest rates move up with Jay Powell trying to lower inflation. What does that do? That makes the value of all those investments plummet. The bank then had this shortfall. Last week, they decided we're going to go out and raise money. It spooks the market. And as Stephanie said, they saw all these depositors pull huge amounts of money out. That caused a run on the bank. It is a unique situation, different from 2008, but one that, as you can tell by the government's actions, needed a rescue.
You know, so Stephanie, U.S. government steps in, launches these emergency measures, allowing customers to have access to their deposits, giving banks access to emergency funds. So in response to this, how are the financial markets looking? Is this going to be enough to put them at ease, do you think?
Well, we'll soon find out. Listen, those involved in SVB.
Not like a bright spot on this because there is no bright spot. But if you look at what happened with the collapse of these banks, if you are a home buyer in the marketplace today, you've actually seen mortgage interest rates decline because when there are challenges in the marketplace, when there's bad news, a lot of times you actually see mortgage rates retreating.
And other smaller banks, especially depositors, were absolutely panicked this weekend. You had companies across the country, as you just heard from that small business owner, that didn't know if they'd be able to operate or make payroll. That has been solved. However, when you look at some other smaller regional banks this morning, their shares are in the pre-market down. People are concerned that there will be contagion. There shouldn't be that concern because the government has made it really clear. If you're a depositor, your money is safe. We have your back. You saw them do it with SVB. You saw the FDIC take over that other bank Stephanie mentioned, Signature Banks.
So one thing that we've seen in general since the 2008 collapse, since that's what we're comparing to, is the government really takes steps to protect businesses and homeowners. In the COVID years, there was a foreclosure moratorium. there were not going to be any foreclosures. People were not going to lose their homes. If people got behind on their mortgages, they put laws in place that allowed people to refinance their homes at lower rates. She's putting a big emphasis, and the president put a big emphasis on making sure people can make payroll, because if people can't make payroll, they can't pay their bills, they can't pay their mortgages. You've seen the government take action when there have been difficult times in the economy in recent years to make sure they're protecting, usually what I think is really like Americans' net worth, which a lot of that lives in homes, in home ownership.
So things are still looking shaky in the markets, but that might just be short term.
So, Stephanie, later this month, the Federal Reserve is supposed to have another interest rate meeting. What do you think, if any, impact this will have on the Fed's decision in terms of rate hikes? And just big picture for people who are in that category of eyes glazing over, what should they know about all of this?
So we'll see what she says, but I spent a lot of time this weekend reading about these collapses, what it might mean to the marketplace, the financial markets. It's not a lot yet on the housing market, but there's one thing you did hear a lot, which, there's the potential that Jerome Powell kind of tightened the screws too tight, that we've been too aggressive with rate hikes. And that's one of the reasons we're getting into these problems. And, he's been boisterous in saying that's what he wants to create. But if he cools down on that, it's likely that we will see some interest rate relief, which will be good news for home buyers and good news for sellers, because a lot of sellers are staying out of the marketplace right now because they're locked into these historically low interest rates, and it's hard to trade out of those into a higher interest rate.
You're just kind of the average person taking in the news with your coffee.
Okay, if you're just the average person taking in the news, you should feel safe with your money. Remember, even if the government didn't bail out, didn't come in and step in, up to $250,000 is protected by the FDIC. So not many people have more than 250 grand sitting in a bank. That's step one. Step two, is the Fed going to raise rates? Listen, we know we're still in an inflationary environment, but Goldman put out a note last night saying they most likely won't raise as much or as quickly as you were thinking. What just happened to SVB is a big warning to Jay Powell. Remember, you raise rates quickly, there are consequences. I'm not saying SVB did the right thing. They absolutely did the wrong thing, but this is a consequence of rates going up quickly.
Right. Stephanie Ruhle, thank you so much. We appreciate it.
So one thing we've seen with these increasing interest rates is in many marketplaces around the country, you have seen home buyer demand decrease. And with that, you've actually seen the amount of listing inventory decrease. So supply and demand have met. So Jerome Powell had said he wanted home values to go in the opposite direction. If you look at the Portland housing market, we're still up over 5% in the last 12 months. There are certain high-priced markets where values have declined, but demand and supply have essentially met, keeping us in a seller's market in a lot of marketplaces around the country. The economic impact of a home sale cannot be underappreciated. I have a document from the National Association of Realtors that shows the economic impact of a home sale in the Oregon area is $176,500. And that goes from the cost of building, selling ladders after someone buys a house, a lawnmower, furniture, just everything that happens. To keep an economy strong, you need home sales. We've had less home sales. Hopefully, interest rate increases will start to slowly decline and we'll see the market kind of come back to normal. If you have any questions about the Portland housing market, you're looking to buy or sell real estate, shoot us a message. There's a link in the description below. If you want to see more videos like this, make sure to subscribe, like our channel, and we'll see you next time.